Welcome to FBS. Curious how people make money trading currencies? You're in the right place. Let's walk you through the basics of Forex trading, step by step.
And what is Forex?
Forex, or foreign exchange, is the global market where people buy and sell currency pairs. It's actually the biggest financial market in the world, with over $7 trillion traded daily.
Which currencies can I trade on Forex?
Everything here comes in pairs. You're not just trading one currency, but one against another. And not all pairs are the same. First, there are the majors. These are the most popular pairs on the market, and they always include the US dollar. For example, euro dollar or dollar yen. They're traded the most and move more steadily. Next, you have the crosses, still big players, but without the US dollar. Think euro pound or Aussie dollar yen. They can be a bit more dynamic. And finally, the exotics, a mix of a major currency and one from a smaller economy, like dollar rand or euro lira. They're riskier, but with more room for bold moves.
So, how do traders make money?
Let's say you think the euro will get stronger than the dollar. Then you buy EUR USD. If you're right and the euro rises, you earn. If it drops, you lose. Think of it like a seesaw. When one side goes up, the other goes down, and traders always try to predict the way it will tip. This brings us to two very different types of traders, the bulls and the bears. Bulls are the optimists. They buy because they believe the price will rise. Bears are more cautious. They sell because they expect the price to fall. Two different outlooks, one market, and both can make money depending on where things go next.
How do I tell whether the price goes up or down?
To figure out where the price might go next, traders look at different kinds of charts. The linear chart shows price as one continuous line. The bar chart breaks it down into price ranges for each period. But the most popular one by far is the candlestick chart. Most platforms use green candles when the price goes up and red candles when it goes down. But there's more to a candle than just color. Each one shows four key things: where the price opened, where it closed, and how high or low it went during that time.
What else should I look at?
Now that you've seen how traders buy and sell, let's take a closer look at the structure of the market. First up, trends. A trend is simply the general direction the market is moving in. If prices are climbing over time, it's called an uptrend, meaning traders usually look to buy. If prices are falling, it's a downtrend. That's when many traders look to sell. And if the price keeps bouncing up and down in the same zone, we call that a sideways trend or a range, where the market has no clear direction. But direction isn't everything. The levels at which price moves matter too. That's where support and resistance come in. Support is like a floor the market doesn't want to fall through. Prices often bounce up from it. Resistance is like a ceiling that keeps pushing prices down. Traders use these zones to plan entries and exits, buying near support and selling near resistance.
Okay, but what are these endless numbers?
They're called quotes, and they show you how much one currency is worth compared to another. For example, if you see that the EUR USD rate is 1.1441, it means 1 euro costs 1.1441 US dollars. But often, you'll see two different rates. That's the bid and the ask prices. Bid is the price you sell at. Ask is the price you buy at. The small difference between them is called the spread, and that's basically the broker's fee. Now let's talk about how prices move. In Forex, even the tiniest change matters. The standard unit of movement is called a pip, usually 0.0001 of a price. But there's a unit that's even smaller than that, a point, which is 1/10 of a pip. So when someone says, "I made 20 pips," they mean the price moved 0.0020 in their favor.
But how much money is that in my pocket?
That depends on how much you're trading, and that brings us to lots. In Forex, you don't trade single dollars or euros. You trade in lots, which are standard units of currency. One standard lot equals 100,000 units of the base currency. A smaller trade, called a mini lot, is 0.1 lots. That's 10,000 units. And the smallest, a micro lot, is 0.01, or just 1,000 units. Those numbers might seem intimidating at first, but does that mean you need $100,000 to start trading? Not at all. Thanks to leverage, you can control larger positions with a much smaller amount.
Okay, and what is leverage?
Leverage lets you trade larger amounts with a smaller balance. It's shown as a ratio like 1 to 100 or 1 to 500. So with 1 to 100 leverage, you can open a $10,000 trade using just $100 from your account. But here's the catch. It can either boost your profits or wipe out your balance just as fast if the market turns against you. That's why risk management is everything in trading. Before opening a trade, a smart trader always sets two key tools: a stop loss to limit how much they're willing to lose, and a take profit to lock in gains once the trade hits their target. For example, if you buy EUR/USD at 1.1000, you might set your stop loss at 1.0900 and your take profit at 1.1050. That way, you know your potential loss and reward before you even click buy.
So, where should I start?
Pick a registered broker like FBS and open a demo account to practice without risking real money. Take it slow, stick to your plan, and remember, learning is key.
And where do I learn?
At FBS Academy. There you can find a wide range of educational materials. Our tutorials, tips, and video lessons will help you learn and grow as a trader. Join FBS and let's make your trading journey prosperous together.